Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Hi, I'm your host, Erin Allen with BMO ETFs. Welcome to today's special episode, which is focused on our mid-year ETF review and outlook. So each year we put out a report, which you're going to get next week via email or on our website if you haven't subscribed. And today you're going to get a sneak peek into that. In this report and today we're going to be talking about a deep dive in terms of what we've seen in flows of ETFs and trends that we're seeing in the ETF market. And we're going to discuss a bit of an outlook for the rest of 2022. So just as a reminder, today we're not providing you any advice or investment recommendations. Today is all about education around investing in ETFs and around the markets for investors who are really just looking to take charge of their own portfolios. With me today is my colleague, Mark Raes, Head of Product for BMO Global Asset Management in Canada. He's on the line. He wasn't able to get on camera today. And also Graham Mackenzie, our partner from the TMX. He's the head of ETFs there. So both Mark and Graham are ETF experts, and I'm so happy to have you both here to take us through a mid-year review. Before we get started, I just wanted to give a quick reminder to check out our YouTube channel. You can watch any of our past episodes on there, and please remember to subscribe and ring the bell so that you're notified every week as future episodes get posted. Now let's get right into the mid-year review. It goes without saying that there's been no shortage of hurdles or risk factors in the market this year. We've seen scorching hot inflation, we've seen rising interest rates, and geopolitical conflict that's really rocked the entire world. It's been an interesting start to 2022. So let's look at what's been happening in the world of ETFs. Graham, we have seen strong flows year to date, but maybe you can walk us through what we're seeing here. This is a chart from National Bank. We're going to have a lot of research from National Bank in today's session, but Graham, walk us through what we've seen in terms of ETF flows in Canada.
For sure. So, despite really a challenging market experience that we've seen in the first half of 2022, the Canadian ETF industry really did well, bringing in about $17 billion in net new assets. Well, that is less than we've seen perhaps in the example the year before. It is really still quite impressive considering the performance of both equity and fixed income markets. Of that 17 billion, roughly 10 billion of that was equity inflows. About 5 billion went into fixed income ETFs, and then we saw a quite a strong $1.4 billion going into your portfolio, your asset allocation, and your multi-asset ETFs. There clearly was a home bias, I think, when you looked at the equity flows going into Canadian and North American ETFs, and that was similar to what we saw on the fixed income side. So all in all, from a ETF industry perspective here in Canada, a very good first half. Obviously, performance in equity and fixed income markets did not do so well. But it's healthy, and it really shows the continued adoption and use of ETFs by investors.
Yeah, I think that 17 billion is still really impressive, all things considered this year. And of course, assets are a bit down, but that's a result of the markets being down. We saw June, you see the red bar there was the first negative month that we've seen in about 3 years, I think. So it's just showing that investors are, starting to are feeling the jitters a bit. Mark, I know it's great to see this growth in the ETF industry because with more people buying ETFs and trading ETFs actually become more efficient. Can you explain why that is?
Sure, thanks, Erin. And yeah, there's two buckets that I would put this idea into. One is the idea of holding an ETF, and the other being the idea of trading an ETF. And I think it's most obvious to see in trading an ETF because as the popularity of the industry grows, you get more people interested, of course, in trading the ETF, which leads to higher volume, tighter quotes, and more efficient trading for anyone from direct trading through to larger institutional trades. So the more popular an ETF is, and this continues to evolve over time, the tighter the trading activity is. The second side, which is a little harder to see, is the idea of the holding of the ETF. And, you know, as more ETFs are successful, it gives providers more confidence to launch new and interesting products, which means for investors, there's more choice to be had. And it also means from a fee perspective that the industry is highly competitive. So you see ETFs in Canada that are essentially priced in line with US equivalents, and that's a reflection of the growth and success of the market here domestically. So again, there's two real wins, one from the prospect of holding an ETF and the other from the idea of trading an ETF.
Absolutely. Thank you. Now, Graham, let's switch gears a little bit. With the growth of the ETF industry comes more and more providers. I think we're at 42 now, last I checked. So walk us through sort of the landscape when it comes to the different ETF providers out there and who's taking the lion's share of the market share.
Well, certainly the lion's share of the market share really sits with the incumbents that have been in the industry for some time. That would include the iShares and BMO as well as Vanguard and some of the others, Horizons as well. But as you said, there's 40 different providers. We've seen an increased over the course of the last 5 or 6 years. That pace has slowed down a little. You know, we've added one new ETF provider here on the TSX earlier this year with Mova Hill Capital Markets. But the reality is we continue to see a healthy competition, as Mark was saying. We're seeing diversity in products. We're seeing the growth of product shelves from some of those providers that joined in more recent years. It's a robust, competitive environment that really the advantage lies with the investor.
For sure, it's highly competitive and it's ever evolving, as you can see, you know, in these charts, just showing you how that landscape has looked over the past 10 years. Mark, as head of product, I can't think of a better person to answer this one. What are the factors that make a successful ETF provider?
Well, I think there's a number of things that come into play. Certainly, you know, experience and depth of offering is really critical. You know, you want to work with a provider that's seen market cycles and, you know, seen the ETF industry and know what pitfalls to watch out for. You know, you want to make sure that the products that are out there are diversified enough, that the underlying is tradable, that it's a liquid basket so that the experience on the exchange is what the investor expects to see. And a lot of that just comes from being in the market and again, being an experienced provider. But as well, that also means that a provider, you know, with a good stable of ETFs behind them can try some different things and be comfortable knowing that the support overall of the shelf supports launching those new and innovative ideas. So you really get wins on both sides there. And the other piece I'd tie it into is, you know, an established provider typically has a lot of material, focuses on education, tries to work very closely with investors and clients because there's that depth of staff and materials that support the ETFs. So while trading the ETF, you know, it can be a one-time thing for a client on the exchange. Education and partnership for sure is ever evolving and continuous, and you need a provider with enough stability, experience, and depth to keep providing those helpful pieces outside of just trading.
Perfect. Yeah, I think that's what we've sort of seen play out, is those providers that are really supporting investors and out there educating are the ones that are really succeeding. Now, Mark, let's look at this slide where we're showing ETF flows by category here. So Graham mentioned that equities have taken the lion's share this year, but can you walk us through the other asset classes and what we saw in terms of flows?
Sure, I think there's a few interesting things to look at, and we'll touch on this as we go, of course. Definitely the theme in the market this year has been inflation shock, and how central banks are dealing with that, and how the economy might respond to aggressive central bank action. And that flows through all the investment decisions that everyone is making. You know, if you look at equities, certainly Canadian equities leading the way. That's because you know, of the more commodity-focused nature of our market. So in terms of inflation, the Canadian market will hold up a little bit better because of, you know, exposure to energy names. You know, if you go to fixed income, you know, it's somewhat surprising to see the positive flows. That's a good proof point for the ETF industry, considering this is a fixed income market, you know, that we haven't seen in a generation. We haven't seen this negative of returns, certainly in years and years, and still flows going in, even to broad market aggregate fixed income exposures that have a little more duration. You know, it's not just crowding the short end of the curve. You know, if you look elsewhere, balanced ETFs continue to grow. That's something that makes a ton of sense. You know, if you think of the mutual fund industry and how much investment is in balanced products, ETFs have a long way to go to have a representative share. But now what's different about the balanced ETFs is they have three-year plus track records, so people can see the performance there as well. You know, commodity ETFs, surprisingly not a ton of flows into them, considering the inflation environment, but certainly people are accessing that through, again, Canadian equity and other ways. Another interesting one would be the crypto space, where, of course, Canada is known for bringing out these products. And despite a very heavy price correction, again, until June of this year, flows were actually holding up in those products, and then we saw some pretty outsized flows in June of 2022. So overall, if you go under the hood a little bit to different asset classes, ETF flows have been very strong across the board, and that's despite the challenge of market returns.
Great, thank you. Yeah, I think that this chart would have looked a lot different this time last year, especially when it comes to crypto. And just looking at that the flows in June into fixed income ETFs is big flows coming into fixed income ETFs, you know, all things considered. Graham, this chart is from National. It shows the top 20 ETFs in terms of flows year to date. Can you walk us through this slide?
Yeah, for sure. So, I mean, when you take a look at this, it really kind of mirrors to some degree what Mark mentioned earlier about where we're seeing things move into. You know, there's the move into equity markets and still seeing some go into fixed income. And if you take a look down that list, you'll see that there's been some sizable flows into some high savings funds, such as the HSAVE and the CSAVE from Horizons and CI. So far this year, there's been approximately, you know, I think 1.6 billion of that, you know, 5 billion into fixed income came from that sector or that asset class. But when you take a look, you know, where did the fund flows sort of go into and what funds, you certainly saw, you know, a preference to Canadian and North American index products. The ETFs that are tracking the S&P TSX 60, for example, XIU and the iShares XIU and Horizons HXT, you know, combined for about 2 billion in flows. And then you sort of look at perhaps some of the actively managed mandates. You saw some really nice flows into BMO ZWB, you know, the covered call bank ETF, as well as some of the balance funds that Mark talked about with Vanguard's and iShares having some flows into those products. And I think from a fixed income perspective, again, things tended to flow towards Canadian funds, and we saw that with everything from ZCPB, the Core Plus Bond Fund, TD's Long-Term Federal Bond ETF, and Horizon's Canadian Select Universe Bond Fund. So it really, as I mentioned, it mimicked really what the big picture looked like as far as like where things ended up going.
Yeah, definitely. I think I was a bit surprised to see ZEB cracking the top 10 this year, being such a specific sector ETF to really get in the top 10. You don't see that very often, so that was nice to see. ESGY, our US ESG exposure, a lot of that would be institutional flows, as that's kind of where the flows are coming from these days in ESG, but that was nice to see. And then another trend seems to be the asset allocation ETFs, of course, and Mark mentioned sort of that greater adoption of balanced ETFs, so we're seeing that come through here as well. Mark, I want to switch gears a little bit and sort of get into some of these more sub-themes. Tech stocks, innovation stocks obviously have cooled off. What was the catalyst for this? Is there something that's going to make this turn around? And do these ETFs still have a spot in your portfolio?
Well, to the last, of course, for sure. Certainly you are investing in these higher growth areas of the market with a long-term lens in mind. So, you got to be willing to withstand the bumps. This is more than a bump, but in order to, really capitalize over the long term. So, the growth sleeve in your portfolio is something you want to maybe buy on the dips and maintain and just let that grow over years and years. If we look at the marketplace this year, whether it's innovation ETFs, whether it's NASDAQ 100 exposures, anything that the valuation was really based heavily on future cash flows. Of course, those growthier names really took it on the chin with the rise of inflation, which led to higher discount rates for cash flow models. Now, as the central banks have been responding very aggressively, now there's concern about an economic slowdown and potentially impacting growth prospects. Certainly earnings this season are coming in a little better than expected, so maybe that'll be a bit muted. But it's a bit of a double whammy for those growth names right now across the board. And it didn't matter if it was tech growth or other areas of the market growth. It's anything that's been really valued on future cash flows has really had a pullback in valuation. But again, if you're using it as a satellite within your portfolio and you're holding onto it for long-term growth, it eventually, and always hard to call a bottom, but eventually looks like a buying opportunity as opposed to something you want to exit.
For sure. Thank you. Now, let's turn to ESG. We saw huge flows during the pandemic into ESG. It's been a little bit slower this year, though we still have seen strong flows, again, mostly from the institutional side of the business. Can you walk us through what's going on in the ESG space right now? There's been a ton of media attention and scrutiny around this, whether it's DWS or Goldman Sachs accusations of greenwashing and the like. What's going on with ESG investing right now?
Well, there's a lot going on in ESG investing right now. First of all, there's challenges on returns depending on how a portfolio is constructed, on the basis, of course, that energy names have done extremely well. That's with the rise of inflation and, of course, the Russian invasion of Ukraine contributing to the rise of energy names. And so if your ESG product is X energy or something similar to that, performance gets a little bit challenged. With BMO, when we follow the MSCI ESG Leaders Indexes, they, of course, look to mimic the broader market sector exposure, so muting some of that. So that's a big question right now in the marketplace. Second, I think, is this idea that people are looking at ESG, environmental, social, and governance, and thinking it's just the environmental. So, you see that coming up of, how can a company that's in certain industries be included in an ESG index? And the answer would be that you're looking at all three pillars, and also because you're probably looking against like companies. Certainly, Elon Musk came out pretty heavily a short while ago, questioning the exclusion of Tesla, while a pretty significant energy company was being included. And that's the rationale that you get to there around the E, the S, and the G, as opposed to just the E, or the environmental. So that's a big piece as well. The greenwashing has been around as an idea or as a concern for a while, but you are seeing more aggressive action by regulators and the like, as we see going in and I don't know if rating is the right word, but going in and investigating asset managers, providers. You need to be able to back up what you say you're doing. If you're saying that you're screening on the basis of certain criteria, you need to be able to evidence it. And when you construct a portfolio and you say you're looking for certain things, again, you need to be able to evidence it. And I think that's very important for the industry credibility as a whole, particularly as there's many different ways that people are approaching ESG, and it needs to be transparent and understandable by investors so that they know exactly the rationale of why companies are being evaluated in a certain manner. So it's a lot in the news right now, a lot of it challenging, but at the end of the day, I think it'll cause the industry to come out the other end stronger, with a tighter story, and probably with a more transparent process.
Yeah, absolutely. It's just forcing everybody to really make sure they're delivering what they're saying they're delivering, and ensuring that investors are looking under the hood. So I see all of this media attention at the end of the day as a positive for the ESG investing space. Let's look at factors. So we use this chart a lot, Mark. It shows the risk-adjusted returns of the different factors. Historically, we've seen a bit of a shift this year in terms of factor performance, but can you talk to us about factors and what you think, or what factors are best positioned going forward for the remainder of 2022 as well?
Sure, and of course we have seen that huge rotation of the market, away from growth towards value in terms of style. But when we get into factors, two really stick out, one being low volatility, the other being dividend. In a market where cash is king and upfront earnings are being valued at a premium relative to future cash flows or earnings, low vol and dividend certainly fit that model. So dividend, where you're looking for mature industry leading companies with hopefully growing dividends, as we do with the BMO ETFs, that's certainly something that reflects well in this market. And then of course low volatility, as market risk has picked up, when you are looking for probably more defensive sectors, but as well more defensive names within those sectors. That's something that has a real place in portfolios right now in terms of protecting relative to broad market exposures, invested capital. And we're certainly seeing significant outperformance across both those factor families this year, primarily because of the market conditions we're dealing with.
Perfect. And I'm noticing a little error here. It should say equal weight. So that's the target, or that's the size factor on this chart. So that's my mistake. Just wanted to clear that up here. Now, Graham, let's look at sector flows. So the chart shows what we've seen in terms of the different sectors. For Canadian flows, can you walk us through here? Where are investors putting their money?
Yeah, for sure. And I think if you look back at the flows that you were commenting, and you mentioned ZEB, the equal weight banks, like it certainly fits where we're seeing people investing. People are looking for, they're seeking out high quality dividend paying sectors such as the financials and the utilities, and you see that where we're seeing fund flows as well. And obviously, the war in Ukraine and the impact that it has had on energy prices has also certainly attracted investors into the Canadian energy sector. So, what you're seeing on this table really reflects pretty much what one would anticipate looking back over the past 6 months. People seeking quality, and very similar to what Mark was talking about from a factors perspective, as well as sort of what the market, how the market is responding to the geopolitical environment that we're in.
For sure, really going into those more defensive sectors that are going to be able to hold up a little bit better in an economic slowdown. Mark, I want to ask you a little bit about energy. ZEO, or equal weight oil and gas ETF, was up about 30% as of the end of June. Can you talk to us about the energy story and what you see going forward here?
Sure. Well, energy is really at the forefront of what's going on in markets right now. As we've talked about the rise of inflation and the Russian invasion of Ukraine, both things that are really pointing to higher energy prices. Certainly, supply has been the big challenge in 2022. Energy came off a little bit towards the mid-year as there was getting to be concerns around demand. Again, if we were going to start to slide into an economic slowdown, that question's still out there. So that's what might hold energy back a little bit. If we look forward, any kind of conflict resolution, of course, would bring energy back a bit. But the big question is going to be, do we get continued heightened inflation, or are the central banks relatively successful at curbing that? And as they do so, are they going to overreach and impact the economy, which would again pull back energy? So that's really the big question right now. And as an investor, that's where you need to have a view on how successful this central bank program is going to be or not. Certainly under current conditions, there's no reason why you can't continue to push higher, and that's keeping in mind the run that it's already had. However, if things were to slow down or supply demand equalize a little bit, that would certainly pull back on energy names. If you look to energy companies, particularly within the Canadian market, they're in a really good place right now, and there's quite a buffer in the oil price compared to their cost of production. So even if energy was to correct quite a bit more, they would still be in a good place, and that's significantly different than where these companies were before this large run-up occurred. So pretty positive for those companies. Lots of room still on the price, and it's just going to be a question of the macro and where that all goes.
Yeah, lots to keep an eye on when it comes to energy. Okay, let's talk about fixed income next. So we've obviously had a really challenging year with inflation, with the interest rate hikes, with sort of the overall risk-off sentiment. What have we seen in terms of performance from the fixed income market and in terms of flows? We have the flows chart up here showing the different segments of the fixed income market. Can you walk us through this? Is
that one me, Erin? I think that's me.
Yeah, sorry, that one's you, Mark.
Yeah, okay, thanks. As we mentioned off the top, really challenging environment for fixed income. If you consider the aggregate market, off 10 to 15%, is something that, not many of us have seen. I certainly haven't seen it in my career. You thought you were buying fixed income for safety as an offset to equity market risk, and we've had a market where both equity and fixed income have come down significantly. So that's been a big challenge in fixed income. The curve has been rising across the board. The curve has been flattening as short-term rates come up pretty aggressively, but inflation pushing it up, straight across the board. So that's going to be, again, the big question going forward. If you look at inflation break-evens using something like TIPS, Treasury Inflation Protected Bonds, they're still pointing forward over the next few years that central banks are going to get everything under control. So there's still that market confidence there, but it's a real short-term hit. And what's interesting now is you're seeing people buy into fixed income, certainly an opportunity in terms of pricing, but as well, what's getting overlooked is because yields are now higher, you get the 10-year moving, north of 150 basis points. That means on a go-forward basis, there's more yield to buffer price volatility. And because there's more yield, if we get a further correction, your payback period is shortened because, of course, you're earning more yield. So if we go back to the historic use of fixed income, which was to generate yield in your portfolio, well, that's starting to show up again, and people are buying fixed income for yield when for years, they were buying it for safety and next to no yield. So there is a positive to it, and people are recognizing that and buying fixed income, but certainly a lot of short-term pain that has caught a lot of market participants by surprise.
And just looking at flows, looks like a lot it's going into those cash alternative, a lot into the Canadian aggregate space, but also the cash alternatives, as Graham mentioned off the top too, with investors looking to sort of keep some powder dry as they evaluate and see what next opportunities may come about. We did have this slide in here, Mark, showing Bloomberg poll of all the different segmented ETFs at BMO across the fixed income market. Did you want to provide a comment here?
Well, I'll try to keep this one quick. A few things to think about. Certainly because of the economic risk and because of the Russian invasion of Ukraine, credit has also been challenged. In other words, corporate bond spreads have widened, high yield bond spreads have widened. So that's another area of challenge within the fixed income market. I mentioned some of the flows going to aggregate. You've mentioned the cash-like trades. Certainly the short bond trades, so that kind of 1 to 5 year time range, that remains popular with investors. The long end, I think unless you're a real contrarian, people have been staying away from that space. There's just a lot of price risk there with rising rates. I think it's been an opportunity within the space for global or differentiated exposures to add value. But by and large, the whole area has been challenged. And so I think you see that as flows kind of move around within the fixed income space, but as well, to your point, a lot of them going to near cash trades.
Great, thank you. Now we had, before we finish off, I do want to touch on inflation as a big theme this year. Obviously, we did have a whole episode on it last week, so I don't want to spend a ton of time here. But maybe, Mark, you can just give us your thoughts on what investors can do to protect themselves in this hot inflation market. Yesterday, 8.1%. This is already out of date, this chart here in Canada, but maybe you can provide your thoughts on that, Mark.
Sure. It depends what area of your portfolio you're looking at. Within fixed income, U.S. Treasury and inflation-protected bonds or TIP bonds, like our ZTIP, is a great option, or Canadian real return bonds. However, those have longer duration, or simply just staying shorter on your fixed income, a little more defensive, is a consideration. But I'd really look at the portfolio overall. I think you want to be thinking about asset classes that do relatively better in an inflationary environment. So now you're thinking about things like energy. So if you had a satellite position in ZEO, that would have done you very well and continues to do well. Something like ZGI or global infrastructure is something that people consider as well. But I would probably point you more than anything to the dividend factor. So looking at lots of dividend ETFs out there in the marketplace. The nice thing about dividends is, of course, they rise over in time. So as long as corporate balance sheets remain healthy, and we're seeing that right now with the earnings cycle, there's an opportunity for those dividends to grow. So maybe getting some more income off your equity side of your book is something to think about right now. And we can take that a step further say, consider some covered calls as well. So if you have concerns about, long-term markets and maybe expect more muted returns, covered calls start with a dividend strategy and enhance that cash flow by writing call options against the underlying portfolio. And again, that's getting more cash up front into investors' portfolio, and those have been extremely popular in the ETF industry.
Perfect, thanks. That's lots of great options and for investors to consider, looking at their own risk tolerance and investment time horizon and all that, but great ideas. Now, before we cap off and get to the audience's questions, I just wanted to turn it back to you, Graham and Mark, just to get your final thoughts as we wrap up the first half of this year and what we might expect going forward. Graham, maybe we'll start with you.
Yeah, sure. I mean, I think the reality is getting an idea of how things go in the second half of this year really will depend on how things play out and how effective central banks could be or are going to be at calming inflation. Will we be able to get inflation under control and continue, economic growth? Or will we see a decline in geopolitical tensions? Will COVID zero in China, though, see some easing of that allows, the supply chain bottlenecks to unfreeze. Those types of things unravel, play out, you're going to see a dynamically different perspective of how the market moves and where flows will be. If you anticipate that it's going to take some time before some of that plays out, then we're probably going to see something very similar to what we've seen, somewhat defensive and buying time. So it's really about interpreting, understanding, and getting some understanding of how effective some of the things that are going on and changes we'll see from a geopolitical perspective.
Yeah, and the good news is ETFs just provide the best tools to navigate these markets. So
yeah, and there's certainly a lot of tools available to investors to navigate.
For sure. Thank you. Now, Mark, any final thoughts from you?
I'll make it quick, Erin. I think in today's marketplace, you've got to be really responsive. Macro events are bullying markets around, and that's where ETFs are such a great tool for portfolios. You don't have to evaluate individual securities. You don't have to trade individual securities. You don't have to evaluate active portfolios. You can get the exposure on that you want with a single ticket solution. So from that aspect, the efficiency and the effectiveness of ETFs only continues to get better. I'm sure we're talking to some ETF users here on the presentation. However, I think the widespread adoption of ETFs is only making the industry stronger.
Thank you. All right, now before we close out, I do want to get to our audience questions. So we'll take these a little bit quicker because I think we're running a bit over, but I can take this first one here. So why has the dividend growth path of ZDY stalled? It seems to coincide with the distribution when the distribution reinvestment stopped. So for the DRIP or the dividend reinvestment, if that stopped, that is something that you'd have to take up with your broker dealer because BMO doesn't really manage that. So all of our ETFs are DRIP eligible, and then it would be up to the broker dealer in order to make that happen. So I would check in with them if that stopped because that seems unusual. And then I did take a look at ZDY. If you go on our website under the tax and distribution tab, you can see all of the historical dividend distributions that have been paid. And I didn't see a stalling there. We've been paying 8 cents a month pretty consistently on that front. So hopefully that deals with your question there. Mark, I'll give this one to you. What are the catalysts of the market rising this week after so many weeks of a downward curve? Is earnings season the only factor?
Certainly not the only factor, but the earnings coming out are the proof point right now that's leading towards a bit of a recovery in markets. And quite simply, earnings have come in, a bit better than expected, which really means, if you're sitting there concerned about economic pressures, that companies are probably a bit better able to weather that than perhaps had been thought. So that's, the primary driver there. Now you could turn around and say, markets have been so distressed that perhaps as well it's a little bit of a relief rally and people buying into a market where they finally see some positive momentum. So that might be a bit at play as well. And again, like our whole conversation, it's going to be looking forward and does the economy slow down? Does inflation get under control? But for right now, if I was to look at something like ZSP or SP 500 ETF, still down about 14% year to date, but up 5% month to date. So you are seeing a bit of pickup here, which I'm sure is welcome relief to a lot of investors.
For sure. All right, the next one, I'll take this one. Markets have suffered a substantial decline recently. Are there specific sectors more resistant than others? So definitely there are, with the defensive sectors like healthcare, utilities, staples, all considered defensive sectors because they're needed at all times, right? And no economic downturn is going to stop consumers from buying those things. So those are sort of the sectors that you would look at to get more defensive in your portfolio, and the sectors that we've really been seeing flows go into recently too. Mark, I will throw this last one to you. In respect to ZRE, what's the outlook on Canadian real estate over the next year? How often is ZRE rebalanced, and what companies does the fund target?
Sure. So ZRE is a basket of Canadian listed REITs, and that's irrespective of the underlying REIT industries. So all of those companies would be eligible, subject to size and liquidity constraints. Certainly heavily weighted to retail REITs. So about 35% in retail REITs is the largest subsector or industry exposure in that portfolio. And this portfolio being equal weighted, rebalanced twice a year. If we look at ZRE, certainly the performance has been challenged this year. It's a cyclical exposure, and when you think about those retail REITs, it's certainly concern on that front that if we hit an economic slowdown, what the flow through impacts would be. So that's certainly what's been holding that back of late. But you do get a diversified equal weight exposure across Canadian REITs. So there's lots of different sub-industries in play that are contributing to that portfolio.
Perfect. Thank you. So that caps off another great week of ETF Market Insights. Thanks, Mark and Graham, for joining me today. We really appreciate having your expert opinions. If you are on our weekly email list, you will get a copy of our mid-year review next week. And if you're not, you can sign up on etfmarketinsights.com. Next week, we're going to be taking a break. It's a long weekend, but we'll be returning on August the 5th. The topic is strengthening your core with broad market ETFs. So no, it will not be an exercise program. We'll be talking about how to create stronger portfolios. I'll be joined by Alfred Lee and Paul Ricardella from MSCI. So I hope you'll join us then. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.